my working hypothesis with the greatest country on earth, country I fought for, country I was happy to fight for, is that it is a country created by real estate investors for real estate investors. So just a quick disclaimer. I don't know about you, but I'm sure everybody on this call is glad the election's over and we can get back to a little bit of normalcy. So this is not a political community, but, and I don't really want to get into the politics or whatever we're going to call it, but we need to discuss macroeconomic policy as investors. So I'm going to keep this into the narrow bandwidth of macroeconomic policy. Another disclaimer, everything's speculative right now. Everybody's guessing based off, what happened in Trump's prior term and what he has said. So everything is very speculative right now. But the most interesting podcast I heard the entire election cycle was, did anybody hear Elon Musk on Rogan?
Yes.
Any thoughts on it?
Incredible. It was great.
Well, and then I love Elon. I love SpaceX. I love the man. He's like Tony Stark. And so listen to the conversation. You guys make up your own mind. But, he's saying he's making his dramatic shifts because he's afraid of an end. He's afraid of censorship in the media and an end of meritocracy culturally, generally in Western culture. So check that out. But very interesting conversation. How's that relative to real estate investors? Well, I think, Elon's take is that he took over Twitter so he could allow for more free speech. And that you can make an argument that the biggest loser in this election was the legacy media. Why is that relevant to real estate investors? Because I'll be honest with you, since I deployed, I've never trusted the media for anything. And I trust them the least amount for investing advice. Hopefully everybody of you on call have seen this, but this is CNBC. This is their real estate reporter. And here is 8 years of saying the market's going to crash. And it is 5, 10, 16, 21, 25, 35, 55, 60, a 60% return. So every year they say the market's going to crash when the market slows down in November, December, January. And then people who listen to this advice have lost out on a lot of money. So I'm also going to kind of riff on, this is from Ray Dalio, one of the greatest investors of all time. But the problem with the media is that the medium is the message. If you only have a 2-minute sound clip, you can't get into second and third order consequences. And in investors, we have to think in second and third order consequences. We got to play chess instead of checkers. So from Dalio, every action has a consequence and each consequence has another consequence. These are called second order effects. Every change you make to a system will have second order effects, which may affect the system's functionality. Failing to consider second and third order consequences is the cause of a lot of painfully bad decisions. And it is especially deadly when the first inferior options confirm your own biases. Never seize the first available option, no matter how good it seems, before you've asked questions and explored. So I figured we take 20 minutes and do that today. But I cannot reiterate, I've been doing this now 6 years. And every time the media has put out a first order consequence, I've had a call like this and be like, no, that's not really going to happen. Most notably was COVID, when everybody's like, the world's going to collapse. And in 2 weeks, I was like, no, absolutely, real estate's going to go bonkers. Probably want to buy as much as you possibly can right now. And then this is Nassim Taleb. Only suckers look at the first order consequences, but proponents of first order consequences, CNN, Fox, MSNBC, all mass media, more importantly, social media, investing off social media. On a couple of the tax calls we've done, we've said like, hey, that's how you get close to the dirty dozen. Politicians, politically active citizens, they really only talk about first order consequences. We as investors have to be talking about second and third. Now, what I am very excited about with the election is the Department of Government Efficiency. So Vivek and Elon Musk, I love that business owners are getting involved because I check my books every month and I have never gone through a budget check and not seen money to cut. So the fact that especially Musk, a genius, is now going to be looking to government efficiency, very excited about that. Very excited to see what capital could get re-released to the market for that. But if I were to give you a bottom line up front about what effect the election will have on the real estate market, it's like it's not that much because this is what I said in August when we went over both candidates' plans. We have potentially generationally large issues that no political policy will help. Now, they might not necessarily make them worse, but hear me out on this one. And so the best book I've ever read on inflation is The Changing World Order. But here is the money supply from 1960 to today. if you look at COVID 2020, 40% of the money that has been created in the economy is 4 years old. And so I have no idea, and I don't think any economist has any idea how that pig's going to get through the python. And I've kind of said this on other calls, but I just don't think anybody in office can have an effect for this for probably 5 to 6 years. This was some also interesting research I was doing. Now, this is not the rise of prices over the last 10 years. This is simply measuring the rate. And so if you look at this blue line underneath here, that's the monthly rate. And so it looks like at the beginning of COVID, there was actually a drop in price. It looks like sometime in 2014, there was a drop in the monthly price. But now the annual prices have always risen. And then if you go back to this slide, this is the value of the dollar since 1913. Dollar has always lost value, except for it looks like during right after World War II. So bottom line is we have a fiat currency. Inflation's not going away. It can be tamed. It can be not thrown into hyperinflation. It can be not so dramatic, but inflation's not going away. Like this was the headline from yesterday. Inflation was up 2.6, not dramatic, but that's a monthly rate rise. And so they lowered interest rates last month. Surprise, surprise, inflation went up a little bit. Like this isn't catastrophic. This isn't a big deal, but inflation's a slow burn and it does affect you. This is also from Ray Dalio. This is what I think of as my own investing portfolio. This is how I make my decisions. This is how I believe most real estate investors should look at things. But here's our 3 biggest risks for investors over time, especially with the changing world order. One is portfolios won't provide enough returns to meet spending needs. What does that mean? It means because of inflation, your returns on investment don't cover your living cost. And at the end of the day, the people who are the people on a fixed income suffer from inflation the most. And so they're the ones most at risk at this. 2, portfolios are ruined through market crashes. I don't think that's a huge possibility. But 3, a large share of wealth is taken away through taxes, wealth redistribution, and inflation. And I think taxes and inflation are the 2 greatest wealth killers for us. Future consequences of money devaluation as the dollar loses and all fiat currencies loses value. Of course, hard currency, hard assets, commodities go up in value. It's just part of the game. So from Dalio, what the future debts held in the reserve currency, right now the dollar, are growing too fast to be paid back in hard money. Money will be printed to service those debts. Cool, that's definitely happening. Interest rates will be held low, below inflation and growth rates. Even at a 7% interest rates are still being held artificially low. So that to me is like, cool. Every dollar I borrow is on sale. And then this is from Dalio as well. The biggest risk is not that debtors will default. Kind of what happened in the Great Depression happened with 2008. It's that creditors' assets will lose value and the returns will be less than inflation. So let me go to this slide. How do we beat inflation? 30-year mortgage. Even everybody's complaining about a 6.5%, 7% interest rate. Doesn't matter. It's still below inflation. And as rates goes down, you can then refi out and get another loan that is well below the inflationary rate. That's how the cash flow gap opens up. You guys, I've talked about this a million times, but your cost stays the same, your rents go up, the house appreciates. That's how these are the best cash flowing inflation hedges. Now, I love Dalio on inflation. Human productivity is the most important force causing the world's total wealth, powers, and living standards to raise over time. So how do you beat inflation? So who's the greatest sufferer of inflation? Someone with fixed income, someone who has, probably retired and is no longer in the productive mode. They're going to get hammered by inflation. Those of us on this call who can still produce and create, we're going to probably be okay, especially if we know how to play the game. And so I was doing a thought experiment, getting ready for this, but inflation means more money chasing the same amount of goods. And so when that happens, when the government's printing money, the prices of goods will go up. And then I was like, okay, well, here's this equation. So macroeconomic price is the money supply divided by total economic production. So if we know it's almost a constant, the government's going to keep producing money, what's the only other option we have to kind of fight inflation? What's the data that says, hey, being more productive fights inflation? Well, all the quantitative easing from 2008 to 2014 and all the Austrians and a lot of libertarian was like, oh my God, the whole government will collapse. Like the problem is they miss the bull market when everybody's producing. So just a thought. So there, I just got that thought out there that, hey, you beat inflation by playing with leverage, especially safe leverage, and you become more productive. And so when we talk about macroeconomic policy, the fact that the new administration, their main things they're running on are energy independence, getting us energy independent again. And so, making money through the production of oil and other energy sources. Okay, cool. That's one way they could help tame inflation. The DOGE, making government spending more productive. That's another way. Releasing that capital back to the economy. That's another way to beat inflation. And 3, lower taxes, which would help all of us become more productive. So, like I said, this is all speculative, but as I think about it, I was like, well, that's the way inflation could be tamed, but I don't know if it can be tamed in 4 years. Like I said, 30-year mortgage is our best weapon to tame it for ourselves. Now let's kind of move on to interest rates. I can't believe I'm saying this, but I think the Fed has done a good job. The Fed's mandate is to tame inflation without creating mass unemployment. Still can't believe those words came out of my mouth. Thus far, now barring a black swan event, they've done a pretty solid job of taming inflation without creating mass employment. And just to kind of be clear, before COVID, before all this stuff, I was still buying real estate as an inflation hedge. Now it's just more prescient. It's more easily seen than it was, say, 2019. But here's the bottom line. I don't think rates are going to move much unless, like Harold said, there's a black swan event. And everybody believes they want interest rates to go lower. I've been kind of contrarian on this one in the real estate world. Like, I don't want low interest rates, because if there's low interest rates, that means something has happened, such as a pandemic, such as a war kicking off, such as a financial crisis. So the fact the economy's done as well as it has since 2022 with interest rates going up, I think has been good for the macro economy. I've been saying that for 2 years. It means we still got gas in the tank. It means if there is another black swan event, if there is another war, we can lower interest rates to zero again without massive hyperinflation. Generally, I'm an optimist. I hope things are going to cool off in Ukraine. I hope things are going to cool off in Israel. I don't think the stock market can take a dump because there's too much currency in the economy. Inflation's a slow burn. So you can think you're getting ahead with the danger of inflation is you think you're getting ahead and you're not. Now, adjusted rates in the stock market, adjusted for inflation, I think there's some serious issues there. But measured against the dollar, sure, it's going to be great. I'm going to kind of move into some more tactical policies here. But as landlords and then people who are flipping houses to FHA, VA buyers, I think the policy of no taxes on overtime and tips, I think that's going to strengthen the rental market because it's going to help with affordability. And those first-time home buyers, they also may be able to pay more for a house. I don't know if that would have a macroeconomic effect, but hypothetically, you could lay out that argument. Next policy, here's something I think is interesting. With all the lowering of taxes, the next concern is that the deficit will just go out of control. So if government spending is not going to slowing down, but hopefully with policies like the DOGE and things like that, spending slows down some, we get more productive, revenues go up. But there's an argument that, hey, if you lower taxes, the government will collect less money. Who agrees with that argument? Has anybody ever heard of the Laffer curve? It's a hypothetical situation. And so Art Laffer, he was one of Ronald Reagan's economic advisors. But if you guys can see my mouse, if you were to tax people zero rate, of course, the government would bring in no tax revenue. But what happens when you tax people at 100%? The government brings in no revenue. And so there are points in history, and one of the government's jobs by policy is to find that happy medium where are we taxing people enough that they just want to still go out and earn and crush? And then because as you start taxing people more and more and more, then they don't want to work as much. So this is a longer story, but my business is a C Corp. When I used to flip houses and it went to my ordinary income, I would get to the fourth quarter and I would be flipping houses and taking all that risk for like 60 to 65 cents on the dollar. So I was like, I'm not going to do it. But now that I have a C Corp structure and my tax rate's 21%, I keep flipping through the fourth quarter. But there is a thing called the Laffer curve where if you tax people too highly, they'll stop working. And I believe in the early 1950s, before Kennedy, like the highest income tax for the highest income earners was close to 80%. So a lot of people just took the fourth quarter off. So I could do some homework. I'll post in the Facebook group if data over time, does the government collect more or less money with higher rates? Well, I think the conversation is, do his 2016 tax cuts expire or not? If corporate income tax stays at 21, and I don't know if he's thinking of I doubt he's thinking of cutting it more, but they're definitely not going up. And so it's like to be seen what happens with the deficit. If we can raise productivity, if we can raise tax revenue, maybe that we can help the deficit issue can kind of go away. Anybody have anything else under that? I was going to move on to immigration. Okay. Policy, immigration. Housing prices could increase because if there's a mass wave of deportation, and the thesis is that the illegal immigration is where we're getting housing labor, then labor for housing could go up. I don't think this will have a macroeconomic effect. I believe this is a regional issue in border cities. And so I don't go ahead. So me personally, I don't think that immigration is going to be that big of an issue, but maybe it puts pressure on labor that prices go up for houses. Tariffs, back to what you were saying, Jeff. If the wrong things are tariff, wood, lumber, housing materials, and technically tariffs get passed on to consumers, but that's not necessarily true because the foreign company could just take less of a margin and then wouldn't pass all of the costs to the consumer. But you could see an argument where massive tariffs are placed on building materials, maybe from China, and then that housing prices increase because of that. And then our inventory problem gets exacerbated even more. I think that'd be a bigger threat to the economy than be good for us probably. But that to me is where tariffs could have an effect. Anybody have any thoughts on that? Okay. Oh, back to one other thing on taxes. Like Dan said, and we've done several calls on this, like the tax, there's probably a 95% tax that the Trump tax plan from 2016 comes back. What does that mean for real estate investors? It means 100% depreciation on the year you buy the house. So I called my accountant today. Here's what that means in real math. It means for every $100,000 of houses you buy, you will get $12,000 back in taxes. I've done other calls where I actually work that math, but the operating number I'm working with is, okay, hey, if I want to save 100 grand in taxes, I need to buy 8 houses. And so here's the fun part. When you guys do a Berkey, you're generally still into the deal between 10 to 15%. If you instantly save on taxes 12% from a purchase, you're essentially getting all of your down payment back on the Berkeys right away. Now, to do that, you got to have passive gains from other places, or you have to be real estate professionals. But those of you who are thinking about getting the 5 houses, getting a spouse, getting somebody, becoming real estate professionals, I'd look very hard into that right now, because I'd say the Trump, like we said earlier, the Trump tax rebates coming back in are at 100% depreciation is probably a certainty. So for us, I think that's the biggest effect it has on. Another policy is they're going to open up federal land for more houses. Most federal land isn't in high population centers. I don't think that's going to have much an effect. I don't think the government can do much. They can lighten up regulation to build houses, but then to see a significant effect on that, I think you're still looking 2 years. So I don't think there's much any administration can do to end the inventory issue.